Welcome to Thriving with Your Money Tree. I'm Mariann Montaigne, CFA, and I am the president and CEO of Mosaic Consulting. Today, we have a guest, one of our podcast listeners, Mary Beth in Atlanta, who's reached out to ask about the 401k program that she's been offered by her employer. Does that sound familiar? Welcome to the Potting Shed, Mary Beth.
Hi, Mariann. It's good to see you. Thanks for meeting with me today.
Good to see you as well. So what are the key questions you have about the 401k?
Well, first and foremost, how much should I be putting into my 401k?
It's a big question.
I do have a company match of 5%. Currently, I've got a total of 13% that I'm investing.
Nice. And your other question?
And then how do I choose from the list of offerings what that type of breakdown should look like?
Okay. Well, as to the 401ks, let me start at kind of square one and tell people that it is a plan that is perhaps offered by your company. You happen to be very fortunate that your company does offer that to you, and they do a 5% match. That's fairly generous. I'd say the range is normally 3 to 6%, but I've heard of numbers on either side of that. And it's a very tax efficient way to save money. Pre-tax money is taken by your employer with each paycheck. So I'm going to just throw some round numbers out there. If you were putting in $1,000 a year, you'd only miss about 700 of those dollars. You're not actually missing $1,000 because of the tax implications. And in a 401k, you are investing according to your choices. So another key question that people have is, when can I get at that money? In a traditional 401k, it's beginning at age 59 and a half. You may be a long ways off from that. Looking at you, Mary Beth, I'd say you are. Or you may be closing in on that age. But if you take money out before that time, there's a 10% penalty in addition to normal income taxes on the money taken out. So if you're working and you're, again, round numbers, you're making $100,000 a year, you take out $10,000 from your traditional 401k, you're going to have to pay a $1,000 penalty on $10,000, and you're going to add that $10,000 to your income when you figure taxes. So it'll look like you made $110,000 that year. So it's only after retirement that the money will be taken out and then taxed at the normal federal and state income tax rates. And after you're retired, expectations are your income is going to be lower and you're going to be in the lower tax bracket. So that's why people do this. Now, in the meantime, you could take out a loan, and that really depends upon your company's rules. But if you take out that loan and then you leave for one reason or another, you must immediately pay back that loan. So think about that when you're thinking about devoting your monies to a traditional IRA, 401k, that is. Now,
some companies will allow you to maintain it if you're just making payments. Like GE allowed me to maintain a loan, and then I just paid it off on it with incremental payments.
Again, every company has different rules, but for the most part, they do make you pay it when you leave. So in the case of a Roth IRA, when you get at the money, it's after retirement. Unless you started the Roth within 5 years of retirement, then you have to wait. It has to be in there for 5 years total before you can take some money out. But that money is invested after taxes. So if you're putting $1,000 a year into the Roth, you're going to miss $1,000 a year out of your paycheck. But here's the thing, later on, your money is withdrawn without any taxes. And unlike the traditional 401k, you will not be told that you have to take a minimum required distribution every year once you turn 70 and a half.
Mhm.
Okay, so all that money can stay in there and can be invested and reinvesting the profits, and it continue to grow forever.
Which one do you consider more like a better investment?
I'm going to say I would use some of each.
Okay.
Because again, you're going to be in a lower tax rate later, but you might want to have that other part set aside, maybe to pass along to your children, or to use as kind of an emergency fund down the road. But so yeah, the Roth would be like my emergency fund or my forever fund.
Okay.
And some people, balk at the whole 401k thing because they say, I need all my money right now. My recommendation is, in that case, start small. Try to institute automatic increases each year, and realize, again, you're not going to miss 100% of the funds. You're only going to miss about 70% of the funds. And some other people think, well, I see big expenses ahead, whether it's a house or a college education for the kids or whatever. You're going to have increased wages in the coming year along with those big expenses. More than likely, your wages are going to grow and they're going to compound. So I would, again, take advantage of the program and start with something you figure you could do without. And as your wages are growing, increase the percentage allocated to your investments. And then on the other hand, you have people who say, I'm not retiring for a long time. Why do I want to do this now? Because of the word compounding. As your money, especially in stocks, grows, it's compounding. So you're getting returns greater than those individual years. It's really a benefit. The sooner you start, the sooner the better.
Right.
Okay. And then some people just say, well, the market is volatile and I only want to buy in when times are low, those times when the market is low. Well, usually those are the times when people are running scared and saying, I wouldn't dare put my money in the stock market. Look what it just did. And it's really the time when you should be investing. So it's just human nature. People don't like to, for some reason, buy something when it's on sale. When the market's gone down 10 or 20%, usually that's when I like to buy things. But no one can predict the ups and downs of the stock market with a high level of accuracy. So you're better off taking advantage of this, and you're buying every month when the markets are high and also when the markets are low. And that is called dollar cost averaging. And you will be practicing dollar cost averaging.
Okay. It's always good to learn something new.
Good. So, you've asked like what amount or what percentage should you put in? And I would say, probably a minimum of 6% of your own money. And again, try to automatically increase that every year. As your wages are growing, it's not like everything else, except for the last couple of years post-COVID, it's not like everything else is going up in price. I think we're going to have a more normal inflation rate going forward, and you'll just have more spendable income, and you should really be putting some of that into your investments.
What about all the options? Like, how do I understand what the options are in all the choices that I have? There are quite a few options.
Yeah, you sent me a list of yours, and I looked at 30 different ones. And I'm not going to go through 30 of them today, but that is overwhelming. And so it brings me back to that question, how do you eat an elephant? And the answer is one bite at a time. So
Okay.
I've got
Can we look at how to narrow some of it down?
Yeah.
I realize
Yeah, I'm looking at, more than 20 that are stocks alone. And then your company is very common in that they offer these target date funds. And my personal opinion is just cross out all those target date funds. They're,
Okay.
if you're estimating you're going to retire in 2040, they have a certain mix of stocks and bonds. And I just don't think that that's something you want to be a part of.
Buy into.
Yeah,
Yeah.
just skip them. And then we'll go into some bond or fixed income choices that they offer you. And they don't have a lot on your particular list, but I'll kind of give you an idea as to how to break them out from anybody's list that they get from their employer.
When we look at the different types or the different types of styles, is there like an additional, besides not looking at the target date funds, what would I look at?
Well, here's the way I break it down. There's larger companies. These are all mutual funds, by the way. There's some that are just larger companies, some that are mid-sized companies, some that are small companies. And then there's bonds, and some of those are corporate and some of those are government. And then some are like cash equivalents. So I guess if you were really nervous, you would put in an allocation to cash equivalents. And this is mid 2023. Interest rates are good. So I don't think you're going to, fail by putting into these money market type accounts at the current interest rates.
Okay.
But let's discuss past returns by category or style.
Okay.
So the first thing I'm going to tell you about is this chart that shows how a dollar invested in 1926 compounded with growth in the stock and bond market. And starting with the best performing sector, that was small cap stocks. And so the growth rate was 11.8%. And again, this is like a 100-year type of chart. We all don't have 100 years investment horizon. However, it gives you an idea of what long-term type of rates are. And so that $1 invested in 1926 turned out to be $49,052 in 2002. Holy
moly. Yeah, that's quite significantly larger than the other return over longer periods of time.
Right.
Looks like.
Now, small cap stocks have more volatility, but it does give you a much greater return. When you look at large cap stocks, the rate of return was 10.1%. And that $1 turned into 11,535.
Okay.
Not a bad number, but not as good as small cap stocks.
Slightly, yeah. So should we let the past 1, 5, 10-year terms or year of returns guide us in what would be the best investment now?
Yeah, I would point to more recent returns, and I would have a contrarian approach to those recent returns. So we'll get to that in a minute. I just want to point out too that if you put your money into government bonds, very safe, very sleep well at night, you would have only gotten $131 back. So bonds are really designed to be some ballast in your portfolio. Typically, they don't move much up or down each year. And at maturity, they pay off what you put in plus a little bit of interest. So principal plus a little bit of interest. So that 131 again compares to small cap stocks at 49,052.
So how do you tell what percentage you would do, like for the ballast, given that I'm in the last half of my career?
Well, okay, in your particular case, and given current interest rates, I might be willing to put as much as 40% into bonds right now. Now, if you had asked me that question 2 years ago, I would have said, forget it, bonds don't pay. And we were going into a rising interest rate environment. That is, the Federal Reserve told us they were going to raise rates and fairly significantly. And that's
Yeah.
really bad for bonds. Interest rates go up, bond values go down like a seesaw. Let's start with 10-year returns. And this is
Okay.
all as of May 30th, 2023.
Okay.
So let's see how they've done over a 10-year period of time. The more recent 10 years, the more recent experience. And we're going to start with large cap and then talk about mid caps and then do small caps. Okay, and then there's 3 categories within each of those. Value, which pay dividends typically. So I'll put a D up there. Core, which is a mix of value and growth. Okay.
Okay.
Now, for large cap stocks over the last 10 years, the return in value has been 9.50%. In core, 11.90. It's looking pretty good. And in growth, 13.38%. Remember, on the longer term, it was small caps that did the best. But over the last 10 years, in the value side, they only provided 5.89%. And in growth, 8.50%. Okay. So does that mean we should go where the profits have been? I don't think so. This is a contrarian type view, but I would be looking at small caps, and I might, you know, have a chunk of my 401k in small cap value. Mid caps are in between at 778 and 734 and 1003. Now, here's another thing. I said small caps have high volatility. You might say, don't want that volatility, I'll go to mid caps. And in that case, I would go with mid cap core, the underperformer over the last 10 years. Okay. I know that growth in large cap has been driven by technology, and what's happened in the past does not guarantee returns in the future. 1 year total returns on these same stock options here. Value was up 2.85, core 290, and growth 1.70. Okay, so I will keep going. Mid caps down 9.63, down 4.70 for core, and up 0.70 for growth.
So why are they down? I mean, why are they down so significantly, that and small caps? What is the difference between a large cap and a mid cap?
So these are billions of dollars in market value.
Okay.
Whereas mid caps go from, and this is very debatable, from about 500 million to 2 billion. And small caps are below 500 million.
Okay, so those are small companies that are startups, etc. Those are the big,
right?
Yeah,
There's
the big gamble.
There's definitely risk. They don't all make it, but the gains and the ones that make it are pretty strong.
Okay.
Okay, so here I'm looking at positives across a large cap, negatives across the mid value, mid core. Worst is small cap value and small cap core overall. These are the worst. This is where I'd like to be looking to buy.
Okay.
Really, really underperformed. And at certain points, investors, institutional investors say, The growth side of large cap has got extended valuations,
Peak.
and so we have to turn to other parts of the market. So I
Okay.
just wanted to go over government bonds real quick. Over the last 10 years, an intermediate term bond, like a 5-year bond, has returned less than 1%. And a government bond that has a maturity of like 20 years has returned about 1.3%. The aggregate bond index over the last 10 years has returned 1.35%. And corporates, 2%. Now, these are, big companies, and they're strong balance sheets. They're going to return the money. They've given you all of 2% on average over the last 10 years, while the low grade, or sometimes I call them junk bonds, have returned 5.44%. So when you're looking at bonds, you can get very different returns. You can get like equity stock type returns from lower grade corporate quality bonds.
Okay.
And
So how many mutual funds should I have in total? Like, how would you suggest, like,
I
a
would
mix?
say look at how those stocks are laid out. And as I was saying, I would take a contrarian point of view. You're going to average in on these over time. And I would say maybe 3 to 5 different mutual funds. 3 is probably enough. Probably an international fund, which your company offers, because the US is only 50% of the total stock market. And
Right.
then on the bond side, I would say 1 or 2. You really don't need more than 2 on the bond side. And I would make sure one of them is corporate bonds, right?
Okay.
Okay. But given all that I've just said, this all depends on your individual risk tolerance and your time horizon. So if you can't sleep well at night with small cap stocks, then you shouldn't have them in your portfolio.
Okay.
Okay, as much as the numbers prove that out, if you're going to wake up in the middle of the night and think I should be selling my small cap stocks because they're volatile, then they're not for you. One size does not fit all.
Okay.
And quite frankly, too, I would say, as I said earlier, a 60-40 mix is probably good these days in terms of 60% stocks, 40% bonds. If you want to be more aggressive, you could have 0 bonds in your portfolio. I'd say if you're at the very start of your career, maybe 10% in bonds would be optimal at this point in time.
If you've got like 10 years,
And
if you're planning on retirement in 10 years.
Yeah, I would say that 60-40 might be a good mix. Well, that's a quick and dirty on how to invest in your 401k. I would say too, you can go to the website for each of those mutual funds that are offered to you. Maybe your company has a place you can click on to get more information. And you can see how they compare to the numbers I've shown you today for the general groups in each of those. The names and the tickers might not match up with what's available to the public, because you're doing this through a private corporation kind of deal. They sort of specialize or customize things for your company, but you're going to be in the same ballpark if you just use those wordings like large cap US or large cap international, run by, say, Fidelity or Vanguard or whoever is in your company list. So just go to the website, you'll get a general idea, and you can make a decision from there.
Okay. Thank you so much. I really appreciate this.
Well, this is something I do for family and friends all the time. It's usually toward the start of the year, but you can make these decisions at any time of the year, and you can also go in and change them anytime.
Okay. Anything else that you wanted to add, Mariann?
Well, I just want to say, go back in and look at it at least once a year and rebalance. If your stocks did particularly well, take some of the profits off of that and put them into your bond holdings. Try to maintain that split that you started with in the beginning. You can do that on an annual basis, or you can do that after the market's had a run one way or the other in, up or down in stocks or in bonds. But that this is a good way to keep your investments in line with your plan.
Okay. Thank you so much.
Well, my pleasure. Thanks for being in the potting shed.